Because in today's time, it's not about how much you make, it's how much you can keep. This unlimited guide will help you harness the full power of life insurance, help you learn how to reduce your taxes, learn how to replace your income, and learn how to create a practice of wealth creation for generations to come. And you don't have to even get this right to understand it. You just have to pay attention. Equip yourself with the knowledge and tools to make life insurance a pivotal part of your financial strategy, ensuring security and prosperity for you and your family. So, now, technically, there's two conversations. One conversation is there's three ways that you get to grow your money: low, medium, high. Now, when I first got into the game, that was what was explained to me. But this conversation right here is what the wealthy have when it comes to their three choices. Their three choices consist of: how do I want to grow my money? Do I want to grow my money in a fixed environment? Or do I want to grow my money in a very volatile, taxable environment? Or do I want to grow my money in an index environment where I get to participate in the stock market but without risking my principal? You tell me. And then their other conversation is how their money is taxed. Because when you choose to grow your money low, medium, high, you don't get to see this. So you got three choices on how your money is taxed. So you have tax now, tax deferred, and tax exempt. So, as a conscious thinking human being, if you had a choice to get your money taxed, I'm pretty sure you would probably choose number one. I could be wrong, but you just never know. But if you did choose number one, this is what you would be looking at. So your first 100,000, grows at a safe 1%. You walk away in 72 years, or somewhere around there with an extra $1,000. But you're taxed 30% on it. So you walk away with 71,000, right? Now, if you had chose tax deferred, of course you don't get taxed on the money that you put in. But guess what? When you decide to take it out, there's all kind of penalties and little surprises that comes along with that. So if you need to access that 100,000 over here, you're gonna walk away with less. Now, excuse me. If you were to put your money in a tax-free environment, and there's some opportunities out there. You got the Roth, the IRC 72E, municipal bonds, and there's a couple other ones. But you have to think safety, okay, and all the other stuff. So if you were to put your money in these environments, of course you would get a very comfortable fixed rate. You'll make your money, the market crashes, you need to access your money, boom. At least you have all your money to access. So as a conscious thinker, which one would you choose? Now, as we continue, just to let you know, IRC 7702 allows you to access any assets you have, right? So if you want to mitigate taxes, this tax code is one of the tax codes that allow you to be able to do that, because what you can do is take a loan from your assets, which are tax-free. So what that allows you to do is to borrow from yourself, say from 6 to 9%. These are just guesstimates; they're not actual numbers, but just something for you to think about. You'll find that out whenever you decide to borrow from yourself, that is. Now, when you do that, you can do a lot of different things. Arbitrage, you can sell the money. There's just so many things you can do that. You may borrow it up to 60%, but you could sell it at 15-20%. There's a lot of opportunity. So, let's talk about the cost of insurance. Because when The cost of insurance is controlled or mitigated. You can use life insurance for protection, emergency fund, retirement, children's savings, emergency savings, etc., etc. And the way that works is if your asset is properly structured to where you're not paying for the whole cost of insurance throughout the rest of your life, you'll be able to take advantage of driving your cost of insurance down as you get older. We'll cover that at some point. So let's find out what makes an index universal policy work. So one of the key components, is the tax codes. Now the tax codes are what governs us. And I'm 57, so for those that remember the name E.F. Hutton, remember that the whole saying that when E.F. Hutton speaks, everybody listens. This slide is going to show you exactly what he was telling them about, because this tax code allows you to reclassify your principal into a death benefit, right? Now think about that. If you keep your principal as a investment capital or principal or whatever the case it is, and under that context, it's taxable. But when you change it to a death benefit, it now changes the whole dynamics of it, and now under that reclassification, that money that grows inside of that grows as a death benefit is tax-free. The interest and the principal are all tax-free. We discussed a little bit about 7702, where just like this is an asset as well, life insurance is an asset, you can borrow from it at a lower rate, sell it as a higher rate, and create what's called arbitrage, to where you walk away with the difference. Now, when you access the money through life insurance, there's three ways to access it. There's a smart way, the dumb way, and we'll leave it at that. The smart way is 7702, you borrow from yourself. The dumb way is to just take a loan withdrawal from yourself, because you're reducing the whole principal, which changes the whole structure of the thing, which just messes it all up. And then the sad way is if you die. We don't want to talk about that, because that's just a safety net, just in case. Now, if you do die, there's this IRC code called 101A that allows you to transfer the death benefit to your heirs, income tax free, so that way you can repeat this process on the next eldest person in your family. That's one way of creating wealth. So what this does is, from generation to generation, unlike any other asset out there on the planet, you can transfer this asset from generation to generation, income tax free. You ain't got to defer it, you ain't got to play with it, you ain't got to massage it. Tax free, period. The other components that we want to talk about is when E.F. Hutton was speaking, when this whole thing came up and he told his clients about these three tax codes. In 1980, the financial institution started taking a hit, because people said, hey, well, why do I have my money in CDs and all these other money market accounts when I can just put my money in here? And during that time, you had very cool interest rates that you can put your money in there and it would just grow tax-free. So his clients, or the institution's clients, just started pulling their money out of the financial institution in droves. So this raised a red flag with Congress. So in 1982, Congress introduced was TEFRA, which is the Tax Equity, Fiscal and Responsibility Act, which found that what E.F. Hutton was doing was perfectly legal according to these tax codes. So from 1980 all the way to 1988, they never made any changes, and here's why. When they found what he was doing and they seen that it was all legal, they couldn't slap him on the hand, so, they said, well, there's nothing wrong. So what they did, they gave themselves an 8-year window. They said, hey, we have this asset that we can dump our money in, and we have a very small time frame to do it, so get as many of your people in as you possibly can. So in 1984, they introduced DEFRA, the Deficit Reduction Act of 1984, which outlined the definition of insurance. So as long as when you put your money in life insurance, that it followed the definition of life insurance, oh, you were good to go. You can dump 500, whatever amount that you wanted to put in there, and you can grow that tax-free. Now, in 1988, when they introduced TAMRA, the Technical and Miscellaneous Revenue Act, this is where they put the brakes on, because everybody that didn't get in, too bad, because from this point on, you can no longer put a lump sum inside of an IUL. You have to break that down over 3 to 5 years. So therefore, if you want to put $100,000 in there, you got to break that down over 3 to 5 years, 20,000, etc., etc. So, but now the good thing is there has been no more significant changes since 1988. So all of us that understand this can get in under these rules, and if they do make any changes after that, everybody gets grandfathered under this situation here, just like those in before 1988 got grandfathered into that situation. So in a nutshell, this is kind of this is the framework. Now, there are 3 components to an IUL. You have your cash, which is your premium, your net risk to the insurance company, and your net death benefit. For this illustration, we're going to use a simple $500,000 death benefit just to show you 2 things. 1, how a properly structured IUL should work, and 2, how your cost of insurance goes down over time instead of your cost of insurance going up. Now, the one thing that I want to point out with this is, what other asset on the planet allows you to put in $5,000? God forbid something happens to you, your family walks away with $500,000 tax-free. What other asset does it? I'll wait. But in the meantime, I'll continue. So, when your $5,000 worth of death benefit, is incorporated into your life insurance policy, what that does is that mitigates the risk to the insurance company. So you may have started out paying for $500,000, but every dollar you put in mitigates your life insurance. And here's how that works. So the first $5,000 knocks it down to $495,000. So that means the risk to the insurance company is $495,000. When your money grows to $100,000, the net risk to the insurance company is only $400,000. You still have a $500,000 death benefit, but you're only paying for $400,000 opposed to $500,000. Pay attention. When your death benefit, cash value increases to $250,000, the net risk to the insurance company is $250,000, but you still have a $500,000 death benefit. When your cash value reaches $500,000, you are now technically fully insured. But because of those citations that we talked about, the insurance company has to have some risk in the game because of DEFRA. Because in order for the insurance company to play, before they were able to dump money in there and the insurance company had no risk. So the Congress slapped a 5 to 10% corridor on them to where they have to have some kind of skin in the game, even though the cash value is increasing. So now you have a $550,000 death benefit, but the question is, how much life insurance are you really paying for? $550,000 or $50,000. Now, mind you, you only started out paying for $500,000. So when you have a properly structured IUL, you can mitigate the cost of insurance this way, because you can lower it, over time as your cash value grows. So that way you use that cash value for whatever you want to use it for. The reason why this is possible is because of what's called an annual renewable term, and how that works with IRC 72E. Every year, your term policy cancels and restarts at the lowest amount of life insurance that the law will allow you to sell under that tax code. So no matter what your cash value grows to, you're always being sold the least amount of life insurance. Most experts out there want to sell you the most life insurance to where you're not getting this kind of growth for your money. This slide is a hint. Now, this next slide will show you how the money grows inside of an IUL. The IUL uses what's called a fixed rate. So whatever company you get with, they're going to give you a fixed rate anywhere between, say, 4 and X amount of percent. So just say you took $100,000 and you put it in an account where you get a fixed 5%. So that means that no matter what happens, you get $5,000, in your account. And because your money is indexed and you're growing your money in life insurance, none of your principal is ever at risk. So say, for instance, you want to increase your rate of return and you want to take your 5% and tell the insurance company to use it as options. Now, the insurance companies are better money managers than banks, because they can actually do this that we're talking about with your money that banks can't do. So anyway, so say, for instance, you say, hey, Mr. Insurance Company, I want to participate in the options. They say, okay, well, we'll take a 10%. So what that means is, if the market does 20%, if the market goes 20%, 30%, they take their 10, you walk away with 20%. Now, those 20% gains are locked, because if the same thing doesn't happen next year, you don't lose anything. That's the power of this asset. Now, just say the market goes in the other direction. Well, remember, you're only using the interest rate that they gave you against your money. So this is basically the insurance's money. So you're only using the fixed rate that they were going to give you, not your principal. So your principal has a zero floor and it's always protected. So if you understand that, you'll understand how the unlimited upside, because there's a uncapped side to where we've been running into a recession about every 7 years. I'm not an expert at it, but if you understand that, you'll see how to use this as a strategy. Because in March of 2021, when the economy bounced back to 66%, there were policyholders who had their money in an uncapped environment who walked away with a 61% after the companies took their 5%, walked away with 61% growth tax-free. Now, I'm not the sharpest knife in the drawer, but I don't know any other asset that will allow you to grow your money at that type of tax rate tax-free, except for in this environment. So say, for instance, you did took advantage. The same thing still applies. Whatever percentage that you get is going to be used into that uncapped, whatever that amounts to is your money. Now, a lot of smart money people use this as a strategy. They'll use this when they know the economy is going to rebound, so they could take advantage of those gains. You have the flexibility within this asset to manipulate those variables every year or monthly, or however your situation is set up. So if you understand how this works, then you'll understand why this asset here you can use for anything: working capital for your business, retirement, college, um, generational wealth, etc., etc., etc. When it comes to buy term and invest the rest, to me, this is that on steroids. I don't know of any other asset out there that even compares to this, especially when you understand it this way. So that's why I took you on this journey. So for those that want to dive more into this, either by way of wanting to know how to set this up for yourself, because I would encourage you to do that, because nobody's going to take care of your money better than you anyway. So if you want to learn how to set this up for yourself and your family, then feel free to get in contact with me. But if you just so happen to want somebody else to set this up for you, make sure that they understand what I just shared with you. Because if they don't, then what they're going to do, they're going to take your money and put it in an environment that you're going to be very, very, very sorry about. So there's the end of my ranting for today. Feel free to reach out if you have any questions. My name is Terrence Thomas. I didn't do a good job at explaining that, but I don't want to make this about me. This is about you and what you can do with your money. And as long as I know the focus is on that, I'm cool. Thank you, and have a blessed journey.